price to book ratio is another valuation stock price ratio. You're evaluating that stock price of that organization in comparison to others in the industry. And price to book, you get that off the balance sheet and its most recent stock price. The formula is the price per share divided by the book value per share. Now, you might be thinking, well, how do I calculate book value per share? It's actually already on the balance sheet. It's listed as shareholder equity. So if you like to do calculations or want to do it, just look for the shareholder equity section, and then you can compute that versus its price to book value. You can compare that, the price to the book value or shareholder equity. And really the idea behind it is the portion of the company that the people own. It's the shareholders. You and me are shareholders. So if I own 2 shares and you own 1 share, I own twice as much stock as you in that particular company. It's a matter of how many shares you have. And so you're looking at the book value and you're dividing by the number of shares outstanding to give you the book value per share, right? So you got shareholder equity, you're dividing by the total number of shares, and that's how much it is per share, book value per share. And that you can then use to compare to the price per share. So you're making fair comparisons, the price per share versus the book value per share. And the idea of the book value per share is that's almost a gauge of what not only the shareholder equity, but also like what is the company kind of worth? It's a good measure to think, the company is really worth at least this. What is $1 of equity? How much are you paying for $1 of equity in this company? So sometimes companies that have fallen on some hard times, or there might be some big fast downdraft in the market, you might get really close to their book value per share. That should be higher than 1, but it might get close or maybe even below. So you're like, boy, I can buy this company and get more of the company for my purchase of that price to the book value of the share. So if you're looking for really valued stocks or low price stocks, you'd be looking for some of the low price to book value is what you're looking at, or P/PB. Or P/B. And if you see a company that's really overvalued, that's got a high price to book, it might also have a high price to earnings, maybe even a high price to sales, that's telling you something that people are really taking on more risk and really putting money into that company and paying a premium. They're paying a lot for that company. They're paying a high for the actual book value of that company because they're thinking hopefully that something's good going to happen in the future. And you have to decide yourself using your other ratios, your other types of investment things we're learning, decide, well, is this true or not? Because you are taking on more risk if you're looking at something that has a high price relative or comparison to its book value. And value investors, they love looking for low price to book value type shares. So you're comparing with the industry, but if you see somebody who's doing great in price to book and somebody who's low, that low company might have the opportunity to raise its stock price, is the idea behind it. Maybe it never does, it just goes down, we get that, but it might be something to look at when it's looking at its price to book ratio.